It's been almost 2 decades we've been on this journey to educate, liberate, and help you take action so you may better manage your financial future, achieve peace of mind, and accomplish your life's purpose. This podcast reveals financial tips, strategies, and insights that will help you set your goals and guide you along the way to help you achieve them. This is Managing Your Financial Future, brought to you by the advisors at Lucia Capital Group. I'm your host, Johnny Dean, with our own Rick the Professor Plum, Chief Financial Planning Officer. All right, Managing Your Financial Future podcast time. I'm always excited to do a podcast. This Professor Plum is so much easier than sitting in front of a camera and doing the whole lights and doing the TV studio and all that stuff.
You really should put something more than just a robe on.
I'm doing the Hugh Hefner thing today. I'll put the pipe off to the side. I am Johnny Dean. Professor Rick Plum here with me from Lucia Capital Group. Professor Rick Plum, certified financial planner professional. And you're here to talk about strategy. It was last podcast, I think, if you listen in order. I talked about the markets going up and down, and they're going to do that forever. The market's going to go up. You might have periods of calm.
Sometimes more than others.
Exactly. But you're going to have periods where they go way up and they go way down. And so this occurred to me, and I happened to get this research from BTN by the numbers, BTN Research. You've seen the same thing. Uh-huh. One question that people often have, especially people who are really thinking about retiring. Let's take this year as an example. They've seen for the last 10 years, 11 years almost, since 2009, they've seen the markets going up. And so they look at their 401k, let's say, and they say, I've got enough to retire. And they say in early 2020, all right, I think by the end of this year, I'm going to retire. Well, a month or two in, the market goes down by 12% at one point. We have all this volatility. And now they're starting to question it, Professor Plum.
Well, they should have been questioning it all along because, yes, the markets have been nothing but up since 2009. That's not a true statement, actually. We've had 6 or 7 declines of more than 10% over
Those
that
are corrections.
Yeah. I mean, we had a big one in 2018. Mm-hmm. And it's one thing to watch a portfolio when you don't have to take any money out of it. It's a completely different game when you want to start distributing money from a portfolio. That same volatility that worked in your favor when you were building your 401k, adding to it every paycheck and all that, now turns around and hurts you when you're distributing money from that portfolio. That same volatility that helped to build the portfolio over time will hurt you if you have negative volatility while you're pulling money out of it.
Well, we saw that with people who retired in 2008, beginning of 2008. The markets were still fairly high at that point. The bear market had only been
high in relative to that date.
Right.
Low compared to today.
Well, no, of course. But in early 2008, they hadn't taken that big dive yet.
Not yet.
So there's the same kind of thing. And so the question becomes, what do I do if the year I retire, my 401k goes down by 20%, or my entire portfolio goes down by 20%.
The year 30%. After I retire.
Yeah, whatever it is. And this shows again the importance of having a strategy, because sometimes we don't control when we retire. Sometimes it's foisted upon us. Sometimes we just can't work anymore. How do you time your retirement so that the market is at the top? You can't.
Well, even if you can control when you retire, you can't control what happens in the markets. And if I do retire today and then the markets go down and I have the no strategy, wrong strategy, whatever, I don't want to have to go back to work.
Right.
Even if I could.
We talked last week about why we do buckets. I'm going to continue that theme for just a moment here. Let me read this for our podcast listeners. You know it because you've seen this. Here's the difference. If you retire at a bad time, like right when the markets go down, or at a good time when the markets are going up. Okay, so this according to BTN Research, okay? And they say the calculation ignores the ultimate impact of taxes and all that stuff. Yes, it does. It's illustrative purposes only. It's not intended to reflect any specific investment or performance, and that actual results will fluctuate with market conditions and will vary. We know that. But this is just to illustrate. Okay, a person with $1 million invested 100% in the S&P 500 as of January 1st, 1973. That's a lot of money back then. But let's say you're a person that had $1 million invested 100% in the S&P 500 on January 1st, 1973. And you say, I'm going to take $100,000 a year out.
10%.
10%. It's a lot of money.
Wow.
And not only that, I'm going to make it inflation adjusted. I'm going to give myself a raise based on, I don't know, let's say the CPI or something like that. All right? It's a risk. But they're going to do it. If they had done that starting January 1st, 1973, they started with $1 million. Do you know that by the end of 1981, 9 years later, they would be out of money if they continued doing that?
Well, yeah. First off, that's a huge distribution. Second off, 73 was a bad year.
It didn't even last 10 years. I could have put it in a mattress and gone 10 years. Not inflation adjusted, of course. Okay, so that's it. You retire January 1st, 1973. It's the end of 1981. You're out of money. You go to your friend who's also got $1 million. It's now January 1st, 1982. And that person who's out of money says, I did a dumb thing. I did a very dumb thing. I had $1 million in 1973. I took out $100,000 a year and gave myself a raise for inflation every year. I am flat broke. And the person now, January 1st, 1982, says, well, I got $1 million. What do you think I should do? And
well, it didn't work for me, but maybe it'll work for you.
The guy says, so the person in 1982 says, you know what? I love risks. I'm going to go for it. I'm going to do exactly what you did.
Even though it worked horribly for you.
Even though it worked horribly for you, I'm brain damaged. I don't care. I'm kidding. I'm going to do exactly what you did. So this person now on January 1st, 1982, does exactly the same thing. They got $1 million. They put it all in the S&P 500. Or you can't really invest in the S&P 500, but itself, but you know what I mean. You put
they somehow had an investment that tracked exactly the S&P 500.
Exactly. Illustrative purposes only. So 1982, January 1st, 1982, they start taking out $100,000 per year, inflation adjusted. So they're giving themselves a raise of inflation.
Yep.
Okay. 38 years later. Well, not only they're not out of money in 9 years.
They didn't run out of money in 9-10 years.
At the end of 2019, just a few months ago, they're still not out of money. Their original million has turned into $5.64 million after 38 years.
Even at taking a 10% of original investment portfolio distribution, which is suicide in most cases.
It's a terrible idea, but
it worked in this case.
Because they got lucky.
Because the market from 82 to basically 2000.
Well, 82 to 90, we saw a little bit of a dip, but yeah, and then 92
the first 8 or 9 years were really good, and then there was a small lull. But by that time, your portfolio had grown so that you're now probably not taking a 10% distribution anymore. You're taking probably a 4 or 5% distribution, and then it grew again through the 90s like crazy. So they had a very good opportunistic time.
They got lucky. So at the end of 2019, this guy who said, way back in 1982, January 1st, said, I'm going to take a risk. He's got $5.6 million. They meet up again. The guy who ran out of money by doing the same thing because he retired in 1973.
He's living on Social Security alone.
And he's living on Social Security alone, or who knows. They meet up and he says, my goodness. You mean all I had to do was retire in 1982 until and instead of 1973, and I would have done that? Yes, you would.
There are numerous illustrations of this type of an issue. Through history.
This is called
sequence of returns.
And sequence of returns risk.
Yeah, sequence of returns risk, and it all has to do with the returns that your portfolio endures in the first, say, 10 years of your retirement. That dictates the rest of your retirement. If you have a couple of so-so to bad years in the first 10, you're probably going to be challenged for maintaining the distribution, unless your distribution is very, very low. On the other side, if you have the next 10 years being very good years, how do you avoid what's going to happen in the next 10 years, since there is nobody that can tell you what's going to happen over the next 10 years?
Well, you know what the simple answer is? The unrealistic answer is just retire whenever the market is about to do very, very well.
Exactly.
Well,
so tell me when it's going to do very, very well.
You can't. You can't do that. You may be able to. I started this off by saying maybe you can retire when you want to. Not everybody can, but you certainly can't control what the markets are going to do in the next 5-6 years after you retire.
Nobody has that kind of control.
The only thing you can do is be prepared in case the market over the first maybe 4 or 5 years, maybe just the first 4 or 5 years, in case the market has some bad first 4 or 5 years.
Now, what we have experienced over all of history so far is that given enough time, even a bad market recovers if you don't take your money out of it. That's hard to do when you're retired. But it also means that any money that I have in the market, I have to assume I have to leave there for a certain given period of time, more than 10 years in some cases. Now, not very many cases does it last more than 10 years, but there have been a few. And if you're Murphy's Law, like some people are, you're going to find the 10-year period of time where you need more than 10 years.
We talked on our last podcast about why we do this strategy. I asked you what kind of a strategy it is. You said it is primarily a defensive move, or whatever you said.
It's managing risk.
It's a risk management, which means that while you're managing the risk, you're not going to take part in the upside.
On some of it.
I shouldn't. You're right. On some of it, you are going to participate, but not to the extent that our second person who invested $1 million, 100% in the S&P experienced. If I were in 1982 or 1973, but if I were prudent in 1982, I would have put some in the market.
Both of those strategies were illogical.
Of course they're illogical.
Well, I mean,
but
those
what
are
I would be,
extremes.
what I would be missing out on, and I don't know how much I'd have after 19 years, if anything, but I would know that I would not have that entire $5.64 million.
No, but I remember playing around with some of these historical things, and where somebody was using a balanced portfolio, a 60-40, 50-50 stock bond mix, and maintaining that mix and taking a distribution from it. One person starting in 69, one person, was it 69? I think, and I'm trying to remember.
We had one from 1969.
And one doing starting
in 1979. Yeah.
And one person ran out of money after 20 years. The other person had boku bucks. And then I changed it a little bit and said, well, let's not be quite so aggressive. Let's do more of a time segment. Say, take half of the money, put it in cash, and leave the other half, but don't take any distributions from it, in that same balanced portfolio.
Yeah.
And the first person who ran out of money in 20 years didn't run out of money in 20 years. They had the same amount they started with 20 years later. The other person did much better, obviously, because they started at a much better time. But what was interesting was after 30 years, the difference between the good person, the person that picked the right time to retire, it wasn't. I mean, it was about 18% difference in total market value. It wasn't 30% more. It wasn't huge numbers. They gave up some upside, but it wasn't a huge number in that particular one-off timed series.
Well, they gave up some upside, but they also
took a lot less risk on the downside.
Exactly. And here we go again with answering the question, why do we do a strategy? Why do you do it? You would never expose anybody to 100% stock market
unless they absolutely did not need a dime from that portfolio at all for at least 10, 15 years.
Even longer, maybe. 10 may be too short. I mean,
10. There's only been a handful of 10-year period of times where
we had,
but it could happen. Yeah, 2000 to 2009.
Absolutely, that was a 10-year period where it was counting. If you don't take dividends, I think it actually was down a little bit. But whatever it was flat.
It didn't produce inflation.
No, it did not. It did not. So we bring this stuff up again to illustrate the point that you cannot control what the markets are going to do. If I could tell you, hey, over the next, you're about to retire, why don't you wait a couple years? Because I know for certain that in the future, I came back from the future, and I can tell you that the markets,
next 3 years are not going to be good.
Right. So work for the next 3 years, and then hold off, and then you're going to have a good sequence of return. You can't do that. You can't do that. Maybe you can figure out when you're going to retire, but the point is to be prepared just in case it happens. This all comes down to strategy.
Right, and the strategy is to figure out a way to take the distribution that you need without subjecting that distribution to the volatility, specifically negative volatility, that comes with market investments. And so how do we get around that? Well, we can't do it forever. So we can't just put 100% of the money, well, unless you have a ton of money. So you can buy time so that market that money that's in the market has its time to go through its little temper tantrums from time to time and recover. Now, that doesn't mean that the market may not go up. Well, if the market goes up instead of down, you've taken advantage of that situation. If the market goes down, you don't have to sell it when it's down, which is rule number one. Don't sell low. And again, we're not talking about individual company risk. We're talking about the market as a whole. So far, because companies can go down and stay down and never come back. Markets so far have not had that experience. Markets do go down, but so far in history, they've always recovered. It's just a matter of how long does it take to recover?
And that's where the strategy comes in. I'm looking at this $1 million in 1982.
That was a lot.
And it was, well, how about 73? It was even more.
Yes.
$1 million in 1982, and you're taking out $100,000 a year and giving yourself a raise every year. What if I just stuck $1 million in the S&P 500 and didn't take that $100,000? Wonder what I would have had by now.
If you had $5-6 million, even after taking 10% a year from the original, I wonder
what that would have done.
I just 40-50. I don't know. We haven't done the math.
But you know what? I didn't have first get $1 million. And yeah. I didn't have that January 1st of 1982. All right, so we've answered the question a couple of times now, why we do what we do. Why do you have a strategy? What is the reason to have that? And the reason to stick with your strategy. Don't panic. I feel like because I know I said this in the last podcast. I know we both said this. Don't panic when things go down. Just have a strategy.
As long as you have the strategy in place ahead of time, you've identified that the money that's in the market is not necessary to support your needs for at least 10 plus years. Chill.
Hey, that's good advice right there. Chill. CHILL. All right, we're out of TIME. We've got more to talk about. What we're going to do is maybe next week, bring in an advisor. I know I talked about this last time, or last season or whatever, that we want to bring in some advisors, people who get other perspectives. You're one of the advisors at Lucia Capital Group, Professor Plum. People like Chris Lloyd. We want to bring in Chris. I want to bring in Preston Schumacher at some point. I'd like to bring in a couple of others. Terry Keys was one. So next week, if I can get one of them, we're going to talk to them. I'm also going to bring in Ray Jr., whom you hear on the intros here. I want to have him in and talk a little bit about the financial planning industry in general.
Joe Lucia as well.
Absolutely. So we'll discuss this season, and we're going to get into more of this stuff. But I want to just leave people with this advice, which is have a strategy and be prepared when the markets go down, because as we saw and have seen and are seeing now, they do. All right, we're out of time. Professor Plum, thank you.
We need to have that music dubbed in. Don't worry, be happy. Yes,
no. Oh, no. I hated that when it came out, and I hate it still. No, thank you. But thank you, Professor Plum. Let's not sing that song. Let me put something else on the record player. If you need to get in touch with Lucia Capital Group, 800-644-1150. Talk to Professor Plum, 800-644-1150, or luciacap.com. For Professor Plum, I'm Johnny Dean. This has been Managing Your Financial Future. We'll talk to you again next time.
The information provided should not be considered specific tax, legal, or investment advice and is not specific to any individual's personal circumstances. To the extent that this material concerns tax matters, it is not intended or written to be used and cannot be used by a taxpayer for the purpose of avoiding penalties that may be imposed by law. Each taxpayer should seek independent advice from a tax professional based on his or her individual circumstances. This material was gathered from sources believed to be reliable. However, its accuracy cannot be guaranteed. Different types of investments and or investment strategies involve varying levels of risk, and there can be no assurance that any specific investment or investment strategy, including the investments purchased and or investment strategies devised by Lucia Capital Group, will be either suitable or profitable for a client's or prospective client's portfolio. Thus, investments may result in a loss of principal. Accordingly, no client or prospective client should assume that the presentation, or any component thereof, serves as the receipt of or a substitute for personalized advice from Lucia Capital Group or from any other investment professional. Examples cited are hypothetical, are for illustrative purposes only, are not guaranteed, and subject to potential federal and state law amendments. There is no guarantee that you will achieve the results discussed or illustrated. S&P 500 Index is an unmanaged index and includes a representative sample of large cap U.S. companies in leading industries. An investment may not be made directly in an index. The information provided is based on current laws, which are subject to change at any time. Lucia Capital Group is not affiliated with or endorsed by the Social Security Administration or any government agency. Social Security rules can be complex. For more information about Social Security benefits, visit the SSA website at ssa.gov or call 800-772-1213 to speak with an SSA representative. It is important to keep in mind that investments in fixed income products are subject to liquidity or market risk, interest rate risk, bonds ordinarily decline in price when interest rates rise and rise in price when interest rates fall, financial or credit risk, inflation or purchasing power risk, and special tax liabilities. Interest may be subject to the alternative minimum tax. Treasury securities are backed by the full faith and credit of the U.S. government but are subject to inflation risk. The investment professionals are registered representatives with and securities and advisory services offered through LPL Financial, a registered investment advisor, and member FINRA SIPC. Lucia Securities LLC was acquired by LPL Financial August 2020. The investment professionals of Lucia Securities LLC are now affiliated with LPL Financial and are conducting business using the name Lucia Capital.